So um, we are looking at a market today worth somewhere between 2.1 and $3 trillion.
Yeah, it's a staggering number.
Right. Just let's sink in for a second, up to $3 trillion.
Hmm.
Over the last decade, this really obscure, poorly understood financial ecosystem has quietly become the absolute lifeblood of corporate borrowing.
It really has.
It basically dictates whether thousands of mid-sized companies can, make payroll.
Yeah, but right now, in the first quarter of 2026, it is facing its first true existential stress test.
Exactly. The cracks are forming, the pressure is building, and honestly, the math is starting to break down.
The sheer scale of the potential unwinding is what makes this moment so critical to understand.
Oh, absolutely.
I mean, we are witnessing real-time structural failures in a system that was designed during an era of free money, and now it's desperately trying to survive in a high-interest reality.
Right. And usually when we talk about a financial diagnosis, there's an expectation of precision. Like, if a public company is failing, you look at their public stock price, you look at their SEC filings, it's like an X-ray.
You can see the break clearly.
Exactly. You break your arm, the X-ray shows the jagged white line, and the doctor just points and says, there it is.
Yeah.
But when you stepped into the world of shadow banking and private credit, that X-ray machine is just broken.
Well, which is by design,
Yeah.
The entire appeal of this market for the people running it was operating outside the strict, transparent, regulatory frameworks that govern traditional banking.
Exactly. And because we're navigating in the dark today, I need to make something explicitly clear right at the top.
Always a good idea.
For this deep dive, we are putting on our Wall Street analyst hats.
Yes, we are.
So the discussion you're about to hear is for entertainment purposes only. It is absolutely not financial advice.
We're analyzing macroeconomic trends and institutional data here.
Right. If you are making personal financial decisions, you need to consult a licensed professional.
We are diagnosing the data, not your personal portfolio.
With that established, welcome to this custom-tailored deep dive.
Glad to be here.
Our mission today is to unpack the 2026 private credit situation. We're going to figure out what exactly this shadow banking market is, what specific mechanisms are actively breaking down right under our noses, the systemic risks, and where Wall Street pundits see us heading for the rest of the year.
It's a lot of ground to cover.
It is. So, to start, if we're going to diagnose a $3 trillion problem, we really need to know how the patient got sick.
Well, the origin story really starts in the wreckage of the 2008 financial crisis.
2008.
Yeah.
Always goes back to that.
Right. After that meltdown, regulators essentially put traditional banks in a straitjacket.
Through Dodd-Frank and all those regulations.
Exactly. Banks were forced to hold significantly more capital in reserve. They had to be incredibly cautious about who they loaned money to. So if a mid-sized company, say like a regional logistics firm or a software startup, wanted a $100 million loan to expand, the big traditional banks simply couldn't take that risk anymore.
But those companies didn't just stop needing capital.
No, of course not.
So if the banks pull back, I have to assume someone else stepped into that vacuum. Because, nature abhors a vacuum, especially in finance.
Yeah, non-bank investment funds rushed in. We're talking about massive alternative asset managers.
Like Blackstone, Apollo, KKR, those guys.
Exactly. They realized they could raise billions of dollars from massive institutional investors like pension funds and lend that money directly to these middle market companies.
And this is what we call private credit.
Right. They essentially became shadow banks, and for a long time it was an absolute goldmine.
Because of the interest rates, right?
Yep.
I mean, if I'm an institutional investor during the 2010s, the Fed has kept interest rates basically at zero.
Basically zero, yeah.
Traditional bonds are paying me nothing. Savings accounts are paying me nothing.
Then a private credit fund manager knocks on your door and says, hey, I can give you a yield of 8, 10, maybe even 12% by lending to these private companies.
Oh, wow. Yeah, you can't say no to that.
It was an irresistible magnet for capital. But the mechanism that made it so profitable back then is the exact same mechanism causing today's crisis.
Yeah, what is that?
The vast majority of these private credit loans were structured with floating interest rates.
Floating rates.
Yes. If we connect this to the bigger picture, it means millions of corporations basically took out the equivalent of an adjustable rate mortgage at the absolute bottom of the market.
Wow. So when the Federal Reserve aggressively hiked rates to fight inflation a couple of years ago, their monthly bill must have just skyrocketed.
The math is brutal. A mid-market company that underwrote its business model expecting to pay 4 or 5% in interest
Right.
is suddenly facing a 10 or 12% interest burden.
That's devastating.
It is. This isn't a glitch in the system. It's the inevitable mathematical reality of borrowing heavily in a low-rate era and maturing in a high-rate era.
Which brings us to the data we're seeing right now in Q1 2026.
Yeah, the ugly part.
Because borrowing costs have doubled, these companies are just bleeding out. The current numbers indicate that roughly 40% of private credit borrowers now have negative free cash flow.
40%.
40%. They literally do not generate enough cash from their business operations to cover their monthly interest payments.
Right, and in a transparent traditional public market, a company that can't pay its interest default?
They declare bankruptcy, assets are liquidated, lenders take a public loss.
Exactly. But remember, the X-ray machine in private credit is broken.
So what are they doing instead?
Instead of defaulting and admitting the loss, many of these funds and companies are utilizing a mechanism called a PIK toggle.
PIK.
Right. It stands for payment in kind.
Payment in kind. Honestly, that sounds like you're bartering chickens for a loan payment.
I wish it was chickens.
So what is it? From what I understand, it means the company is allowed to pay its interest obligation with more debt instead of actual cash.
That is exactly the mechanism. If a company owes $1 million in interest this month but doesn't have the cash,
Yeah, the lender simply adds that $1 million to the total principal of the loan.
so the company now owes more money overall, but they don't have to produce cash today.
Exactly.
Wait, okay, let's unpack this. If a borrower is paying their debt with more debt, isn't that just a corporate balance transfer on a credit card?
That's a great way to put it.
You're just moving the balance from a Chase card to an Amex to buy yourself 30 days. At what point does this capitalized interest become terminal cancer for a fund's actual value?
Wow.
Because I read that PIK now accounts for nearly 10% of revenue for major business development companies. We are just inflating a massive bubble of unrealized imaginary gains.
You're not wrong. The psychology behind it is actually driven by the fund manager's incentives.
How so?
When you use a PIK toggle, the principal amount of the loan grows, right?
Right.
Because private credit fund managers charge fees based on total assets under management, they are perversely incentivized to let the loan grow larger on paper.
Wait, really? Yeah. They collect higher management fees on an asset base that is increasingly fictional.
That is insane. And nobody stops them because of the transparency gap?
Exactly. These loans aren't traded on the New York Stock Exchange. The free market isn't telling us what they're worth every second of the day.
We use a system called mark-to-model, right?
Yeah.
Which is really just a very fancy Wall Street way of saying the funds get to grade their own homework.
That lack of price discovery is terrifying, especially when you look at the rare moments the curtain actually gets pulled back.
Like the BPM report.
Yes. A recent report from BPM Valuation Services isolated a single loan to a cybersecurity company called Magenta Buyer.
Okay.
2 different private credit funds held the exact same loan on their books.
The exact same loan.
Exact same loan. One lender valued that loan at 79 cents on the dollar.
Okay.
The other lender looked at the exact same company, the exact same financial data, and valued the loan at 46 cents on the dollar.
A 33-cent discrepancy on the dollar for the exact same asset.
It's wild.
If you scale that kind of valuation gap across a $3 trillion market,
Yeah.
the implications are just staggering.
It means investors have absolutely no idea what their portfolios are actually worth.
Right. But if the underlying math is breaking, we have to look at who is actually holding these loans because it's not evenly distributed.
Not at all. A massive concentration of this private credit boom went to one specific sector.
The sauce-pocalypse.
Yes, what the market is currently dubbing the sauce-pocalypse.
Software as a service. During the zero-interest era, B2B software was basically a religion on Wall Street.
It really was. Software companies were viewed as the perfect borrowers.
Why is that?
They had predictable recurring revenue from subscriptions, incredibly high margins, and really asset-light business models.
Right.
Some private credit portfolios have nearly 40% of their capital concentrated entirely in mid-market software companies.
But the entire thesis of a software company is that their proprietary code is their moat, right? That code was the collateral for billions of dollars in loans. And over the last couple of years, generative AI has come in like a wrecking ball.
A total wrecking ball.
So a private credit fund might have loaned $50 million to a company whose entire business model was providing, say, proprietary customer service chatbot software. But overnight, an AI model can be customized to do that exact same job for $20 a month.
Yep.
The software company's moat evaporates, their revenue collapses, and suddenly that $50 million collateral has vanished into thin air.
The speed of that technological disruption is why UBS recently released a downside scenario modeling this specific AI-driven collapse.
And what did they find?
They estimate that private credit defaults could reach 15%.
Wow.
To contextualize that, 15% is roughly 3 times higher than the peak delinquency rates we saw for traditional bank loans during the depths of the 2008 financial crisis.
Here's where it gets really interesting, The market thought interest rates were the bullet, but it turns out artificial intelligence is the actual weapon taking out these tech borrowers.
And the apex predators on Wall Street see the writing on the wall. Prime brokers.
Meaning the massive banks like JP Morgan that lend money to the private credit funds.
Exactly. The banks lending to the funds so the funds can lend to the software companies. They're taking action. They aren't waiting for these software companies to officially miss a payment.
What are they doing?
JP Morgan is preemptively marking down software-related loans unilaterally.
Wow.
They're basically looking at the AI disruption and saying, we don't believe your homework anymore. They're pulling the plug on the leverage these private funds rely on.
So when a prime broker marks down the collateral, it shrinks the borrowing base for the private credit fund.
Yes. The fund is forced to deleverage, to pay back the prime broker at the absolute worst possible time.
Which leads to the most visible, panic-inducing part of this whole crisis.
The gating?
Yeah. If I'm an investor and I see AI destroying the collateral of the companies my fund lent to, and I see JP Morgan pulling back their leverage, my natural reaction is to hit the sell button. I want my money back.
Naturally.
But investors are finding out the hard way that the exit doors are locked. Let's dig into this gating phenomenon.
This exposes a fatal structural flaw in how private credit evolved. Over the last few years, the major funds ran out of pension money to absorb, so they pivoted hard toward retail investors.
Everyday people.
Exactly. They created these semi-liquid funds that aggressively marketed a high yield with the promise that investors could withdraw their money on a quarterly basis.
But how does that even work mechanically? You can't just take a retail investor's money, promise them they can have it back in 90 days, and then lock that money up in a highly illiquid, highly bespoke 5 to 7 year corporate loan to a mid-market software company.
No, you can't.
You can't day trade a corporate loan like a share of Apple stock.
This raises an important question, right? Did retail investors truly understand that liquidity in private credit is a feature of the fund's structure, not the underlying asset?
It's an illusion of liquidity.
Complete illusion. The funds relied on the assumption that new money coming in would always exceed the old money wanting to leave.
It's like a crowded theater, where the exit door only lets out 5% of the panic-stricken audience at a time.
That's a perfect analogy.
Imagine looking at your retirement dashboard right now. You see a solid 10% return. You click the withdraw button, and a pop-up essentially says, check back in 3 months, and maybe we'll give you 5% of what you asked for.
The scale of the withdrawal requests we are seeing right now proves the panic is real.
Like with Blackstone, right?
Yes. Blackstone's flagship BCRD fund was hit with $6.5 billion in withdrawal requests in a single quarter.
$6.5 billion.
That represented 7.9% of the entire fund. The panic was so intense that Blackstone executives had to personally inject $400 million of their own capital just to stabilize the optics.
Oh my God.
And it's not just them. BlackRock had to cap its HPS fund after withdrawal requests hit 9.3%. Morgan Stanley, Blue Owl, Cliffwater, they are all dropping the gates, strictly limiting redemptions to around 5% per quarter.
And when you gate a fund, you trap the capital, which just creates more panic.
Exactly.
But it also forces the fund managers into a terrible corner. To scrape together the cash to pay out that meager 5%, they have to sell up their most liquid, highest quality assets.
Right, the good stuff.
Which means the investors who are trapped inside the fund are left holding a portfolio composed entirely of the most toxic, unsellable AI-disrupted loans.
It's a brutal cycle. And this is where we have to zoom out and look at the macro picture.
Yeah.
With funds locking their gates, 40% of borrowers in negative cash flow, and defaults projected to hit 15%, the inevitable question becomes one of contagion.
Systemic risk. Are we looking down the barrel of 2008 all over again?
That's the big fear.
Will this localized panic in shadow banking spill over and infect the broader banking system that touches everyday checking accounts and mortgages.
Well, the rhetoric from historical analysts is certainly ominous.
Mm.
Whalen Global Advisors recently published a piece comparing the psychology of today's market to the 1920s, right before the Great Crash.
Really, the 1820s. Right.
Yeah. They noted that observers today, much like back then, seem completely convinced that asset values have reached a permanently high plateau,
Oh, wow.
that financial engineering has somehow conquered the business cycle.
But the mechanics of the crisis feel fundamentally different than 2008.
How so?
Well, 2008 was a liquidity crisis. It was a sudden, massive heart attack where banks simply stopped trusting each other overnight and credit completely froze.
True.
What we're looking at in 2026 feels more like a solvency crisis, a slow-motion organ failure where these over-leveraged companies just slowly bleed to death over years of sustained high interest rates.
The distinction between a heart attack and slow-motion organ failure is vital when we talk about the traditional banks.
Okay, tell me more about that.
The Nederlands Bank recently ran a severe stress test modeling a crisis scenario specifically for these business development companies.
And what did the models show?
Their models showed that under extreme stress, these funds might have to delever by 10%, and up to 35% might face technical defaults on their credit facilities.
That sounds really bad.
It is, but their ultimate conclusion was that a total systemic collapse of the banking sector might be avoided, provided the traditional banks show forbearance.
Meaning the big banks don't immediately force the private funds into bankruptcy. They give them time to work through the bad loans slowly.
Yes. Keep the patient on life support, rather than pulling the plug and realizing the losses all at once.
Well, hold on. The mainstream says we are safe because banks aren't directly holding the toxic mortgages this time.
Right, that's the narrative.
But the Senate Banking Committee just threw a massive wrench into that comfort narrative.
They sure did.
They sent a warning letter to the Federal Reserve about something called hidden leverage. Specifically, they pointed to synthetic risk transfers, or SRTs, which have quietly hit $1 trillion in volume.
$1 trillion.
I keep hearing about SRTs. How do these actually work? Because honestly, it sounds like a shell game.
It kind of is. A synthetic risk transfer is essentially a bank buying an insurance policy on its own loan portfolio.
Oh.
Say a massive traditional bank has $1 billion in loans on its books. They want to free up capital, so they pay a premium to private investors.
Like an insurance premium.
Exactly. The deal is, if those loans default, the private investor takes the loss, not the bank. The bank has officially transferred the risk off its balance sheet.
Okay, so the bank is protected. But who are these private investors taking on all this massive risk?
What's fascinating here is that the entities buying that risk are often collateralized loan obligations or CLOs and massive life insurance companies.
A life insurance company.
Yep.
And they aren't just using their own cash to buy this risk. They're using borrowed money. They are levered up 9 to 10 times over to buy these SRTs.
Wait. Let me get this straight.
Go ahead.
The banks offloaded the risk of $1 trillion in loans to private investors.
Yes.
Those private investors use massive amounts of leverage to buy that risk, and they packaged it into life insurance annuities and CLOs.
That's right.
If the underlying loans start defaulting because of the SOS-pocalypse, those leveraged private investors get wiped out, which means the life insurance companies take the hit.
Exactly.
So if you're a retiree and you expect your pension or your death benefit to pay out, but that money is trapped in a gated private credit fund that just got wiped out by a failed SRT, didn't we just transfer the systemic risk from the bank directly to you, the everyday retiree?
The complexity of these instruments is designed to obscure exactly that reality.
That's horrifying. The core banking system appears highly capitalized and incredibly safe on paper, but that hidden leverage wrapped up in life insurance wrappers and retail retirement dashboards is the true blind spot of 2026.
Wow.
The systemic risk didn't vanish after Dodd-Frank. It just migrated into a darker, less regulated corner of the financial system where retail investors are holding the bag.
All right, so having diagnosed the underlying pathology here,
Yeah.
the floating rates crushing cash flows, the PI toggles masking the pain, AI destroying software collateral, the gates trapping retail capital, and SRTs hiding the true leverage.
The long list.
It is. Where do Wall Street pundits and analysts actually see this market heading for the remainder of the year?
The consensus forecast points to a brutal period of price discovery.
Meaning?
We are going to see more funds dropping the gates to trap whatever capital they have left. Because investors are desperate for liquidity, we will likely see an explosion in the secondary market.
Uh.
You will have retail investors and smaller institutions selling their locked-up private credit shares at massive, punishing discounts just to get their hands on actual cash.
Just trying to escape.
Exactly. The era of the safe 10% yield with perceived quarterly liquidity is officially dead.
And what happens to the private credit funds themselves?
Massive consolidation. The smaller funds that relied entirely on financial engineering, aggressive mark-to-model accounting, and PI taggles, they'll be wiped out or absorbed.
Right.
The landscape will consolidate into a few surviving mega managers. Analysts also forecast a hard pivot away from cash flow lending, which was the basis of all those doomed software loans.
Because AI ruined it.
Right. And a return to asset-based lending. Moving forward, lenders are going to demand loans backed by hard, physical, tangible collateral like real estate, machinery, or heavy inventory.
Things AI cannot replicate.
Exactly.
So what does this all mean in a massive unwinding like this? Who actually comes out on top?
The undisputed winners will be the distressed debt specialists.
Like who?
Firms like Apollo and Ares, who specialized in chaotic environments. They are sitting on massive amounts of dry powder, billions in uncommitted cash that is locked up for the long term.
Oh, I see.
They're going to swoop in and buy up these distressed, discounted loans from forced sellers for pennies on the dollar.
Who else?
The other major winners will be the traditional banks, like JP Morgan. They are going to use their pristine, federally backed balance sheets to reclaim all the market share they lost to the shadow banks over the last decade.
It sounds like the scavengers are about to have a feast while the retail investors hold the bag.
It is the harsh, cyclical reality of financial markets. Whenever a period of rapid, unchecked growth collides with a shifting macroeconomic reality, it is invariably the least sophisticated capital that bears the brunt of the adjustment.
Which brings us to why you, the listener, should care deeply about this, even if you don't have a single dollar directly invested in a private credit fund. This $3 trillion shadow ecosystem dictates the flow of capital in our modern economy. It dictates whether the mid-market company you work for can afford to hire new employees, whether the local vendor you buy from can expand their warehouse, or whether they can even keep the lights on.
It's all connected.
If this credit spigot freezes, the ripple effects don't stay contained on Wall Street. They hit the real economy in the form of frozen hiring, abrupt layoffs, and a broader, grinding economic slowdown.
Credit is the oil in the engine of the macroeconomy. When the oil gets sludgy and filled with toxic loans, the engine inevitably seizes up.
Yeah.
And the fallout impacts everyone, regardless of whether you personally own shares in the oil refinery.
It really forces you to re-examine the entire financial narrative of the last decade.
It really does.
I mean, we were repeatedly told that this shadow banking revolution with a noble democratization of finance, that it was taking power away from the big, rigid, traditional banks and giving it to agile, innovative private funds that could fund the future.
That was the pitch.
But as we sit here in 2026, watching these private funds gate their retail investors, watching them desperately beg the traditional banks for forbearance, and watching those same big banks swoop in to buy up their assets at a massive discount, it leaves you with a very unsettling question.
What is the question that stands out to you?
Did the grand shadow banking revolution actually disrupt anything at all? Or did it just end up acting as a highly paid temporary holding pen to warehouse the riskiest debt right up until traditional Wall Street was ready to buy it all back on the cheap?
When you look at who is holding the bag and who is holding the cash, the answer seems fairly clear.
It really does. It turns out the financial X-ray machine isn't just murky. The image it shows depends entirely on who owns the hospital. Thank you for joining us on this deep dive. Stay curious, stay informed, and we'll catch you next time.
Until next time.